Hey guys, it's Kyle Miller from Mortgage Center Ottawa and KyleMillerMortgages.ca. Just as a follow-up to another blog post I put up a few days ago, if you listen to my blog post about payment shock, and which is basically the jump from paying a low interest rate to a high interest rate, and how to manage that difference in between. You may have been wondering, well, why are we talking about this? I'm at a high rate and I'm actually going to renew into a low rate because of all the economic factors that have been going on. A lot of people now are paying 5-6%, and if they renew in the next, if they renewed or will renew in the next, 3 to 5 months, you're still going to be paying lower. You're going to jump into an interest rate at like 4%. Payment shock is more for someone who's buying right now because they're going to enjoy that low interest rate today, and they're going to have to renew into a higher rate in like 3 to 5 years. Why am I telling you this again? Because we've already talked about it. Essentially because just the other day, Tuesday, May 31st, the Bank of Canada came out with their announcement saying that they weren't changing the low interest rates that we have. They weren't changing their lending rate, but it was just a matter of time before they actually had to start doing that. Why do they have to start doing that? It's called inflation. What's inflation? Here's a quick economics lesson today, kind of in layman's terms. What happens is that when we're in a period of economic growth, people have money. People have been encouraged to spend money, go out and buy some stuff, help the economy out. We go out and buy stuff because we have money. What then happens is that the supply of that stuff decreases, so the demand is oversupply. When demand is oversupply, prices increase. It's just the way it works. So prices increase, and that's inflation. So you paid $1 for gum last month. This month it's going to cost you $1.02. That's inflation. What happens is if inflation happens too quick, the government has to step in, slow down inflation, so everything like incomes, for example, catch up to inflation, so that it rises at the same rate, and then everything kind of stays the same. What that means is that to do that and to help curb inflation, they do stuff like raise interest rates. They'll raise interest rates, which is good if you're a borrower because your return on investment's good. It's not so good. Sorry, if you're an investor. If you're an investor, it's good because it's going to pay you back more. If you're a borrower, it's going to cost you more to borrow the money, and that's what we're talking about. So this is really just a blog post to tell you that what we were talking about can happen and most likely will happen because the rates we're enjoying today are not going to last. So what happens? Does that mean you don't want to buy a house today? No, you do potentially want to buy a house today because it's going to be more affordable today. What you have to do is set yourself up with a strategy to be able to afford it down the road because we know those rates are going to increase. And that's where we would like to implement a strategy for you to help you plan for that and help you build for that so that payment shock doesn't hurt you down the road. So go back to my other blog post called Payment Shock. Then read the article that I've attached below because it'll kind of explain what's been happening. There's a couple of them there, so they're kind of neat just to have a gander about. And if you have any questions, please give me a call, 613-863-1979. You can also always check out, always get me on email, Kyle@mortgagecenterottawa.com. Hopefully this helps. Leave me a comment. Let me know what you think. Let me know if you want to know something, and I'll gladly blog about it. And we'll talk to you soon. Thanks.